This is Cece. Welcome to the Orbit. We've got futures pretty much unchanged. We're looking at the SPY, which is down 1 cent. Right now, that is a 0.4% expected move, 0 DTE today, which is about just under $2 in either direction. And we are currently unched right now. Now, we talked a little bit yesterday on the Orbit about 0 DTE moves. Yesterday, at that moment, futures were down below where options were pricing the day. We'd seen the same thing the day before. We saw it a couple of times last week. Now, yesterday was an interesting example because that initial move lower did get bought. The markets finished pretty much unchanged yesterday. And so the 0 DTE expected move got violated in the morning, but then held up to be true at the end of the day. Now, that should inform, or that could inform, some trading there, taking that initial expected move. If you are a 0 DTE credit trading type, to take that initial move, perhaps, in a situation like that, it's the initial move is beyond the expected move, but that is a chance to potentially put on a credit put spread, have the market rally back, and then as it's rallying back, sell a credit call spread, and there you let to an iron condor. That is the way a lot of people trade. Yesterday's conditions were sort of the exact scenario that you would be looking for and how that would play out. So something to keep an eye on. Look at those initial expected moves. Look at those initial moves. And if they're at or about maybe a little bit beyond, is that something that then has a center of gravity back towards unchanged? And if that's the case, then those are sort of perfect conditions for legging in and legging out of things like iron condors. Now, I say that, and then we have the CPI tomorrow morning. So we're looking at a 0.7% expected move for today and tomorrow combined, and then a 0.8% expected move out into Friday. So that tells you where most of the volatility lies this week, and you can actually see it in the IV, is for tomorrow. So tomorrow is going to be what options are pricing as the thing. If we move this week, it will probably be based upon that CPI number. And we might see some craziness into the close today. By craziness, I just mean a normal move at this point because we are unchanged. But you could see some pre-CPI positioning in the market into the close. But if not, what options are saying is most of this week's movement should come tomorrow, and that doesn't necessarily mean there will be movement, but that's how options are pricing, is about a 0.7, 0.8% move for the rest of the week. So still very low volatility. On Friday, as mentioned, is probably the first big day of the new earnings season. We get reports from JP Morgan, Citi, Wells. We're looking at the XLF ETF, not necessarily as a trading vehicle for earnings. Bank earnings tend to, they have some mixed moves, right? They all report on the same morning, and sometimes one will be higher, one will be lower. But this XLF is sort of the trend of all of those stocks combined going into this earnings season. And you can see where we are on the 1 year chart. We're up above these levels. Going back to last February, we've had this monster rally into it. Firm positioning and trading, and if you're long some of these stocks, or if you're long a bunch of these stocks, hedges, of course, would be very inexpensive. Now, in this case, what we're looking at, in the individual hedges of any of these stocks, or perhaps doing it with an XLF type pretty far in time without being penalized. I mean, not just set up for some, obviously things will be very cheap just for earnings, but you might not get a move correct in, even an individual name like a JP Morgan, and you might not get it correct in XLF, because if Citi's up and JP Morgan's lower, then your hedge in XLF might not necessarily work. But if you go back out in time, especially looking at that 1 year chart, you could go out into March and find some pretty inexpensive put spreads. We've got an expected move of about 4.5%. Now, remember, this is up almost 20%. So there's some opportunities here with some put spreads very realistic hedging in these kinds of sectors going into earnings. And the same would be true for um, semiconductor stocks, you name it, mega cap stocks. There's those ETFs out there. If you are sitting on, especially if you are sitting on some profits of some of these type names, and you're looking for those kinds of hedges going out, you can go out to March, you can go out to April, and not really be penalized much in time because volatility is low. We're looking at the Qs out into March. That is 17 vol. We've got about a 5% expected move, a multi-month move of only about 5%. So you can see that, obviously, if you were taking some bearish positioning here on the app, you would be getting, and you would be able to play around with this, play around with some strikes. And how much am I willing to risk? Where do I want that protection to kick in? We're looking at a 390, 375 put spread here. That is disaster, not even disaster protection. That is only down 16 points, but it is something that would kick in after an initial sell-off if it were to carry over, and this is the type of thing you would be looking for if you were long, say, a lot of these mega cap stocks. So anyway, that's how you should be looking into earnings season. If you are sitting on some of these stocks, before Friday, we will get into how to actually, some different ways to actually trade the earnings themselves.